Hi everyone. On behalf of HDIN Research, we are pleased to present our comprehensive strategic review of Hanwha Solutions. As the global energy landscape undergoes a paradigm shift, Hanwha is at a critical inflection point. Today, we will analyze their 2025 performance, the ongoing transition from traditional chemicals to renewable energy, and how they are navigating a complex macroeconomic environment. To begin, let's look at the current state of play. Hanwha Solutions has evolved into a highly diversified industrial powerhouse. While many know them for their petrochemical roots in basic materials, the company has successfully expanded into renewables via Q-cells, advanced materials for the EV sector, and insight for specialized real estate. Their overarching goal is clear: to transition from a commodity-driven player to a vertically integrated, high-value total energy solutions provider. However, this transition is not without its headwinds. The company is currently facing a, quote, perfect storm in two areas. First, the basic materials segment is suffering from a global oversupply, largely from China, resulting in a significant operating loss. Second, the massive capital expenditure required for their U.S. solar hub has strained the balance sheet, pushing the debt-to-equity ratio to over 65% at a time when cash flow remains tight. This brings us to the pivotal question of our analysis. How can Hanwha Solutions maintain the delicate balance between funding their aggressive solar ambitions in the U.S. while managing the cyclical downturn in their legacy chemical business, all while ensuring long-term financial solvency? Looking at the numbers for the first 9 months of 2025, we see a story of recovery. Despite the challenges, revenue grew by over 23%. Most importantly, the company achieved a turnaround in operating profit, swinging from a loss of 407 billion Korean won last year to a 125 billion Korean won profit. While net income remains negative, the losses are narrowing significantly. If we peel back the layers, the divergence in segment performance is striking. The renewable energy division is now the undisputed engine of the company, generating nearly 2.4 trillion Korean won in profit. This has effectively cushioned the 1.28 trillion Korean won hit taken by the quote, basic materials segment. It confirms that Hanwha's pivot to green energy is no longer just a strategy, it is their survival mechanism. Regarding solvency, the debt-to-equity ratio stands at 65.4%. While this is high, it reflects the quote, investment phase of their life cycle. We note that the company successfully secured 2.14 trillion Korean won through financing activities this year. The key concern for investors remains the liquidity ratio, which is currently below 1.0, necessitating disciplined cash management in the coming quarters. Our cash flow trend analysis shows that we are likely past the quote, trough of the investment cycle. Operating cash flow remains negative, but the burn rate has slowed compared to 2024. As the Georgia solar hub begins to scale, we expect the heavy capex burden to ease, allowing for a return to positive free cash flow by late 2026. Hanwha's core competitive advantage in renewables is its commitment to full vertical integration. By controlling the entire value chain, from wafers to software-driven virtual power plants, they are capturing higher margins and insulating themselves from supply chain shocks that plague competitors who only manufacture modules. The U.S. solar hub in Georgia is the centerpiece of this strategy. This is a direct, calculated response to the Inflation Reduction Act. By manufacturing domestically, Hanwha not only bypasses trade restrictions on Chinese components, but also positions itself to receive massive tax credits that will significantly boost net margins over the next decade. Beyond scale, Hanwha is investing in moats through technology. Their focus on perovskite silicon tandem cells aims to push solar efficiency beyond current limits. Furthermore, by internalizing equipment manufacturing from Hanwha Momentum, they are ensuring that their production efficiency remains a proprietary advantage. In the basic materials segment, the strategy is decommoditization. Hanwha is shifting focus away from standard PVC towards specialty products like bio-DEHCH and green hydrogen technologies. The goal is to reduce exposure to the volatile price swings of the general petrochemical cycle. Our capacity dashboard highlights high utilization rates in PVC and caustic soda, despite the market downturn. The advanced materials segment, while currently at a lower operating rate, is positioned for a rapid scale-up as global EV production picks up pace. It is often overlooked that Hanwha is a global leader in lightweight composites. With a 63% market share in GMT, they are a critical supplier for the EV transition. This segment provides a high-margin, stable revenue stream that complements the more volatile energy business. The Insight segment acts as a strategic stabilizer. By developing industrial complexes and data centers, Hanwha is leveraging its land assets to generate steady, non-cyclical returns. This provides a valuable hedge against the fluctuations of the global energy and chemical markets. Risk management is paramount. Our sensitivity analysis indicates that Hanwha is highly sensitive to interest rates, with every 1% rise impacting pre-tax income by roughly 19 billion Korean won. They are actively using forward contracts and swaps to mitigate the impact of a volatile KRW-USD exchange rate. From an accounting perspective, we see a move toward greater transparency and relevance. The shift to a, quote, fair value model for investment properties better reflects the company's true asset base, while more rigorous impairment testing for Qcells goodwill shows a conservative and realistic approach to valuation. However, investors should monitor the company's off-balance sheet commitments. Hanwha Solutions has provided significant guarantees for affiliates, including a $400 million loan for Hanwha Future-Proof. While these support group-wide growth, they do represent a latent credit risk if those subsidiaries underperform. Looking ahead, 2026 will be the year of harvest as the solar hub reaches full capacity. By 2028, we expect to see the first commercial pilots of tandem cells, culminating in their 2030 net zero leadership goals. The roadmap is ambitious, but structurally sound. In conclusion, HDIN Research views Hanwha Solutions as a resilient player in the midst of a successful transformation. The renewable engine is now powerful enough to offset legacy material losses. While debt levels and market cyclicality remain risks, the U.S. vertical integration provides a moat that few can match. We maintain a positive outlook on their strategic positioning. Thank you for your attention. We will now open the floor for any questions. For those seeking deeper market research or specific financial modeling on the energy and chemical sectors, please feel free to reach out to us at HDIN Research via the email provided on the screen.